Are you leaving money on the table every tax season? Many taxpayers, students, investors, and small business owners misunderstand the fundamental difference between tax deductions and tax credits. This crucial distinction can significantly impact your financial planning and tax preparation. Let's demystify these powerful tools and empower you to optimize your tax strategy. The confusion between deductions and credits is widespread, primarily because both ultimately aim to reduce your tax burden. This surface-level similarity often leads people to use the terms interchangeably, expecting the same financial outcome. However, their mechanisms are fundamentally different, leading to varied results. This misunderstanding can cause frustration and missed opportunities during tax preparation. It's vital to grasp where each tool applies in the tax calculation process to make informed financial decisions. Understanding this distinction is the first step toward effective tax education and planning. A tax deduction works by reducing your taxable income, not your final tax bill directly. Think of it as lowering the amount of your earnings that the government considers subject to taxation. The process is straightforward. You earn income, certain deductions reduce that income, and then your taxes are calculated on the remaining, lower amount. For example, if you earn $50,000 and have $5,000 in deductions, your taxable income becomes $45,000. Your tax liability is then computed based on this reduced figure. This means the actual cash value of a deduction depends entirely on your marginal tax bracket. Deductions are powerful tools for various financial situations. For individual taxpayers, common deductions include the standard deduction or itemized deductions like mortgage interest, state and local taxes, SALT cap applies, and charitable contributions. These can significantly lower your taxable income. Students often benefit from deductions for student loan interest, which can reduce their taxable income by up to $2,500 annually. Investors might deduct certain investment interest expenses or capital losses, helping to offset gains. Small business owners have a wide array of deductions, from office rent and supplies to employee salaries and advertising costs, all reducing their business's taxable profit. The term write-off often creates an inflated expectation of a deduction's impact. While deductions are valuable, they don't reduce your tax bill dollar for dollar. A $1,000 deduction, for instance, won't save you $1,000 in taxes. Instead, it saves you your marginal tax rate multiplied by that $1,000. If you're in the 22% tax bracket, a $1,000 deduction saves you $220, 22% of $1,000. This gap between the perceived value and the actual tax savings can be a source of disappointment. Understanding this mechanism is crucial for accurate financial planning and setting realistic expectations during tax preparation. In contrast to deductions, tax credits directly reduce the amount of tax you owe, dollar for dollar. If you have a $1,000 tax credit, your tax bill is immediately lowered by $1,000. This makes credits generally more powerful than deductions, as their value isn't dependent on your tax bracket. Credits apply later in the tax calculation process, after your taxable income has been determined and your initial tax liability calculated. They are a direct reduction of that final tax amount. This direct impact makes credits incredibly valuable for maximizing your tax savings. Tax credits come in two main forms: non-refundable and refundable. Non-refundable credits can reduce your tax liability to zero, but you won't receive any money back if the credit exceeds your tax due. Examples include the child tax credit, partially non-refundable for some, the credit for other dependents, and the lifetime learning credit. Refundable credits, on the other hand, can reduce your tax liability below zero, resulting in a refund even if you paid no taxes. The Earned Income Tax Credit, EITC, and the Additional Child Tax Credit are prime examples. These are particularly beneficial for lower-income taxpayers and families, providing significant financial relief. To simplify, remember this core framework: deductions reduce your taxable income, while credits reduce your taxes owed. Both are essential components of a sound tax strategy, but they operate at different stages of the tax calculation. Neither is a magical solution, but understanding their distinct roles makes tax outcomes predictable. For taxpayers, knowing this difference helps you identify which expenses qualify for which benefit. For students, it clarifies the impact of education-related tax breaks. Investors can better plan for capital gains and losses, and small business owners can strategically manage their operational costs for maximum tax efficiency. Effective tax preparation involves identifying every eligible deduction and credit. This requires meticulous record-keeping and a clear understanding of current tax laws. Don't overlook potential savings by misinterpreting these terms. Regularly reviewing your financial situation and consulting tax resources can help you uncover opportunities. For small business owners, tracking all business expenses is paramount to claiming legitimate deductions. Students should keep records of tuition payments and loan interest. All taxpayers should explore whether itemizing deductions or taking the standard deduction is more beneficial. This proactive approach is key to robust financial planning. Understanding deductions and credits is more than just tax education. It's a cornerstone of effective financial planning. It allows you to make informed decisions throughout the year, not just at tax time. For instance, knowing the value of a charitable contribution deduction might influence your giving strategy. Similarly, understanding the impact of a child tax credit can help families budget more effectively. Investors can plan their portfolio adjustments with tax implications in mind. Small businesses can strategically time equipment purchases or hiring decisions to maximize deductions. This knowledge empowers you to optimize your financial health. The distinction between tax deductions and tax credits is fundamental to smart financial management. It's not just about filing your taxes, it's about understanding how your money works for you. By grasping these concepts, you can move from confusion to clarity, transforming your tax preparation from a chore into an opportunity for significant savings. If you found this explanation helpful, please give us a like and share it with others who might benefit. Every like we receive inspires us to create more valuable content like this. Subscribe to our channel for more insights into tax education, financial planning, and smart money management. Take control of your taxes today and build a more secure financial future.